I'm Alan Kenny, Editorial Director with REIT.com, and I'm in Chicago, Illinois for REITWeek 2013, NAREIT's Investor Forum. Joining me is Stephen Marks, Managing Director with Fitch Ratings. Stephen, I know that Fitch Ratings was pretty positive on REIT's liquidity position earlier in the year. Still positive now?
If anything, we're more positive. We just put out a report about 2 weeks ago where we said that liquidity is the best ever as we analyze it. And that's really been driven by a couple things. One is just the tremendous access to capital that REITs have had to term out their unsecured lines, access equity, and otherwise fund their development and their other opportunities.
So I know that Fitch Ratings just put out your mid-year review of REIT's position. Tell us a little bit about some of your conclusions there.
Sure, yeah, we'll do. We did just publish our mid-year outlook today, and the outlook on the overall equity REIT sector is stable, and that stable outlook is driven by a couple things. On the positive side, one is that access to capital has been fantastic. The aforementioned liquidity has been quite strong, and fundamentals have been improving as well, generally across most of the sectors. Those positive elements are balanced, however, by a few things. One is leverage that we still believe is elevated in the sector, and secondly is the overall macroeconomic environment, which remains slow, and it's something that commercial real estate and REIT specifically can't really de-link themselves to over a long period of time. So as the job market goes, as the overall economy goes, so goes commercial real estate.
And you just mentioned leverage. Do you see the lending standards potentially tightening up for REITs anytime soon?
We don't. If anything, particularly on the secured side, we're seeing the secure market being quite strong, and we don't. If anything, we see a loosening on the secured side. As it relates to the unsecured side, we see continued strength, and if anything, we see strength for some inaugural issuers. For instance, companies who are issuing the unsecured bond market for the first time. If there were ever an opportunity to issue and access the unsecured bond market, the time is now. And for investors, it's probably a good opportunity for them to pick up some incremental yield from some inaugural issuers.
Okay, we're 6 months into the year. Give me the stories that you're watching in the second 6 months of the year.
There are a few things that we're paying closer attention to. One is to what extent REITs begin to go out on the risk spectrum, and that could be in the form of speculative development, could be in the form of highly levered M&A transactions, or potentially M&A transactions that aren't good fits. On the flip side, we are potentially looking at growth in the IPO market. Certainly with valuations fairly strong and the M&A environment beginning to pick up, that's certainly a better time for some private companies to get a good gauge on where valuations are. And wouldn't be surprised to see some new entrants in the IPO space.
Okay, well, thanks a lot for your time, Stephen.
Yep, thank you, Alan.
And for more on this and other REIT news and analysis from REIT World 2013, be sure to check out REIT.com.